Lockheed Martin is an interesting dividend stock, and as the stock markets become more volatile with the incoming administration making threats of tariffs and geopolitical tensions and etc., accelerating inflation, investors start to look for these safer defensive type investments, and Lockheed Martin is certainly that. So in this video, I'm going to evaluate Lockheed Martin stock and answer what I think is a fair price to pay for this business and all of the factors that go into the valuation of this business. So let's dive in. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so here I have my discounted cash flow valuation model for Lockheed Martin Corporation. And I'm going to go through each of these steps one at a time, each of the parts of this discounted cash flow model one at a time, describing what each of these numbers mean, and finally letting you know what I think is a fair price to pay for this business. So let's jump in, starting with the free cash flows. So these numbers here, the free cash flow, these are estimates from Wall Street analysts that are following Lockheed Martin. They think the company's free cash flow will start at $6.5 billion in 2025 and rise to $7.38 billion in 2029. Roughly $800 million in growth there in free cash flow. And you'll notice that this isn't very fast growth. And it's typical for a company like Lockheed Martin to grow free cash flow only incrementally, not very quickly. That's the nature of this business. And so that's par for the course here. From 2029 to 2034, I'm forecasting the company's free cash flow grows at a 6.7% compounded annual rate, and the free cash flow rises from 7.38 billion up to 10.2 billion in 2034. So I'm forecasting the company's free cash flow grow at a little bit better rate over the next 5 years as in the first 5 years forecasted. From 2035 onward, I forecast the company's free cash flow will grow at roughly 5%, which is equivalent to the nominal rate of growth of the US GDP. Nominal rate of growth, right? Not real rate of growth. The difference between the two is adjustment for inflation. I'm not adjusting for inflation here. I'm just forecasting the company's free cash flows nominally. And so that's why you see a 5% instead of a 3% terminal growth rate for Lockheed Martin. And then we have the terminal value here of 445 billion. What the terminal value does is it brings together all of the free cash flows expected between the year 2035 and infinity. Instead of me forecasting all of them individually all the way out like 200 years, I can use a terminal value calculation, which takes the free cash flow 1 year ahead in 2035, divided by the weighted average cost of capital minus the growth rate. And that's what gives you the terminal value here. And I'll share with you my inputs for the weighted average cost of capital. It is 7.4%, and the long-term growth rate is 5%. So the denominator is 0.074 minus 0.05, and the numerator is the $10.7169 billion. That's where we get the terminal value of $445 billion here. So with all of these cash flows, we need to discount them back to today, because these are all expected at various points in time in the future, but we want to know what the price of the stock is today. What should be the fair value of the stock today? And when I do that, I get a value of operations total of $271 billion. As I highlighted earlier, the weighted average cost of capital I'm using is 7.4%. You can see that in the section highlighted in blue right here. 7.4% weighted average cost of capital. I'm arriving at that by using a cost of debt of 7.5% and a capital asset pricing model cost of equity of just 7.4%, which is among the lowest you'll see in any of the companies I follow. And it's because Lockheed Martin has a beta of only 0.48. That's among the lowest betas of any business you'll see me evaluate. And the reason the beta is low is because the business is not so risky. It's mostly a defense contractor, and its sales are locked in for years and years into the future. It's locked in. And so if the economy grows, doesn't really matter for Lockheed Martin. If the economy declines, doesn't really matter for Lockheed Martin. Its business is not correlated to the market overall. And so that's why you have such a low beta for a business like this. It's appealing to investors to have this kind of business because oftentimes investors don't want that exposure to the market because they already have so much exposure to the market. Even just if you're not a professional investor, if you're just an individual, and let's say you have a business, you have exposure to the market already. If the economy is booming, your business is probably going to do well. And if the economy is in a recession, your business is probably going to perform poorly. And so when you're looking at stocks and you have a stock that's dependent on the performance of the economy, that's now added to the risk of your everyday life where you have exposure to the performance of the economy. And so investors look for these kinds of businesses that are not so closely correlated, right? Lockheed Martin, Eli Lilly, Novo Nordisk, Pfizer, etc. These are companies that are not so strongly correlated to the economy. And then we have the risk-free rate at 4.5%, a market risk premium of 6%. And since they have total debt of $20 billion on a market cap of $109 billion, I'm giving them a target capital structure of 80% equity and 20% debt. That's how I arrive at the weighted average cost of capital of 7.4%, which is incredibly low. It's among the lowest of any of the companies I'm following, and it's due to primarily the very low beta. And because of that, I've ran a scenario with a higher beta, which I'll also share with you. So now we can draw our attention here to the value of operations of $271 billion. And to that total, we need to add the company's cash balance or non-operating assets of $2.483 billion, subtracted debt of $20 billion, and we arrive at a value of equity of $253 billion. If we divide the number of shares outstanding of 239 million, we get an intrinsic value per share of $1,060. Of course, that compares very favorably to the current market price, which is just $449. And remember I shared with you that the beta has a big role to play here? Well, I shared with you the actual beta of the company right now is 0.48, according to Yahoo Finance. Well, I ran a scenario evaluating what the intrinsic value per share would be if I increased the beta from 0.48 to 0.75, and the intrinsic value would be $660 per share. So $400 lower than if the beta was 0.48. And so I think this scenario is a more prudent scenario to evaluate this business, to look at it with the beta between 0.48 and 0.75 instead of just taking the beta of 0.48 because it's so much lower than the average stock. The average beta is 1, and if a beta is 0.48, it's significantly lower. So the intrinsic value per share, what's a fair price to buy Lockheed Martin stock? I would say if you can get Lockheed Martin stock at $660, I would say it's a good value. And the current market price at $449 is certainly a good value according to these calculations. But of course, do your own due diligence before making any conclusions about a business. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.